Hello, I'm Jeanine Poggiolini. I'm the Technical Director at the Accounting Standards Board, and I'm going to talk to you today about the results of our review of the amendments that we have made to GRAP 16 on investment property and GRAP 17 on property, plant and equipment. I'm going to talk to you about the results of our review on GRAP 16 and GRAP 17. Just to give you an overall idea of why it is that we are doing these reviews, it's a fairly new initiative that we've undertaken during the 2017 to 2020 work program cycle. We have already done a review of the presentation of information in the Statement of Financial Performance, and then secondly having a look at GRAP 16 and 17. What we've tried to do with these reviews is really assess entities' compliance with certain parts of the standards, and then we also have a look at practice that is emerging and why it is emerging, and really understanding what the complexities are in applying the standard, if there's additional guidance that's needed or if amendments need to be made. You will see us doing more of these reviews going forward during the 2024 to 2026 work program cycle, and we'll do 3 similar reviews and follow the same process. Importantly, why is it that we are reviewing the amendments that we made to GRAP 16 and 17 in particular? You may recall that we did a post-implementation review of these 2 standards quite a number of years ago. As a result of that review, there were some amendments that needed to be made to the standards, and what we are really doing with this review is assessing the effectiveness of those amendments and whether or not they are achieving their objectives. So there are 6 particular areas that we are going to focus on, and I'll run through those in a minute. Just to give you an idea of how we went about doing the reviews, firstly we covered all entities that apply standards of GRAP, and the modality that we followed was really to do a desktop review of the financial statements, but as you would appreciate, we can't get all the information from the financial statements alone, so we had issued questionnaires to preparers, auditors and other parties to really give us some feedback about how they had applied some of the amendments. And then quite importantly, we do engage with preparers, auditors and others to really get an understanding of our findings, to understand why it is that certain amendments may have been applied or not, or applied in a certain way. What you will see is the end result is a research paper that we have published on our website. We published it in December of last year, so you'll be able to access it, and really the aim with these kinds of reviews is really to communicate what our findings are in an attempt to improve both compliance with the standard and really the quality of the financial statements. So to give you an idea of the scope of the review, we did review the financial statements of all entities that apply standards of GRAP. So that would cover municipalities, public entities, parliaments and legislature, as well as the TVET colleges. We focused on 6 areas, which was the distinction between property, plant and equipment and investment property, applying an indicator-based approach to the review of useful lives and residual values, the use of external valuers, encourage disclosures where we had actually deleted the requirements to present this information and really understanding if entities are still providing this information, disclosures on capital work in progress, and then as well as disclosures on repairs and maintenance. Before I move on to the detailed findings, I think I just want to share with you some general observations, and you'll hear us talking about this quite a bit over the next year, I guess, is really that what we find is that when entities present their accounting policies in the financial statements, we find that they are very generic. They are not customized at all to the entity's circumstances, and they generally explain the existing principles in the standards rather than how they were actually applied by entities. I'm going to share with you 2 examples, just snapshots of 2 financial statements that we would have reviewed. The one is a municipality. It's actually a local municipality where they are responsible for direct service delivery to communities. The next example is a public entity. It's actually a performing arts entity. If you have a look at the 2 accounting policies, you will see the wording is exactly the same. Although you would appreciate that the entity's activities and the level of assets required to do that are completely different, yet the asset notes look exactly the same. I think, take it as an example, I mean, the very first paragraph just talks about property, plant and equipment. There are tangible, non-current assets held for use in production of supply of goods and services, rental to others, etc. This is really just the definition from GRAP 17. It isn't actually explaining what assets an entity has, nor is it explaining anything if you read further on about what are the particular issues around recognition. You could appreciate that cost capitalization would be an issue, borrowing costs, useful lives, residual values, all of these things. It's not really coming out exactly how the entity has applied this to their particular circumstances. It really is boilerplate, very generic, just repeating the standards. This is really not, from our perspective, the expectation of what we would like to see in the financial statements, because, as I said, if I'm a user and I pick up these two entities' financial statements, I would not get any idea of what it is that their business is and how they've applied the accounting standards. So I'm going to start with finding one, which is the distinction between property, plants and equipment and investment properties. So just to recap, the definition of property, plants and equipment would really be assets that you use for the provision of goods or services, for administrative purposes or rental to the others. Investment property would really be land and buildings in particular that you obviously rent to other parties or you hold for capital appreciation. I think what we had heard during the review of these standards is that particularly where there is rental, it isn't particularly clear when certain assets should be property, plants and equipment and when they should be investment property, and it's because this idea that in both instances you could be receiving rental for the assets. So this is what we had heard, and in terms of our amendment, we had made it quite clear that if you are using assets to deliver on your mandate as outlined in the Constitution or other laws or regulations, you would always be classifying land and buildings as property, plant and equipment. So if you think about certain entities that might be in the game of providing social housing, it could be that they provide housing to their employees, it could be that they need to make certain facilities available for rental on either a short-term or a long-term basis. If it's in your mandate to do these things, those assets would be classified as property, plant and equipment. If not, then it would be investment property. Another important aspect that we have clarified is that I think there was this expectation that for something to be in investment property, that the rental that you earn needs to be market related, and that isn't the case, because quite often government entities might want to promote economic development in certain areas, so they could enter into lease arrangements or similar where the rental is not market related. But again, if this is not something that's particularly in your mandate, you would be classifying that as an investment property rather than PP&E. The other thing that we have clarified, it was actually in GRAP 16 to start off with, is this idea of land held for strategic purposes. So you would know already that if you have land that you hold for an undetermined future use, that would always be investment property, because the idea is that you are speculating in land in those instances, so you're holding it for capital appreciation. Land held for strategic purposes is slightly different. So what we have explained is that if you as an entity has made a decision, a resolution of your board or your council or whatever the situation might be, that you would eventually earmark this land or whatever it is to be used as for service delivery, so then it would directly form part of your property, plant and equipment. So I think we've just tried to clarify the difference between land held for an undetermined use versus held for strategic purposes, and if the strategic use is going to be for property, plant and for service delivery, then it would be property, plant and equipment. So what did we find? I think what we had heard from preparers and others is really that the changes had been helpful in making the distinction between PP&E and investment property. It was a lot clearer. What we had also heard is that obviously the changes had really required entities to take a good look at their asset registers and understand whether or not the classification was correct. And obviously there were related accounting consequences that they needed to either process an error in their financial statements or a change in classification. We did receive some feedback about additional examples that should be considered. The first one is the differentiation between inventory and investment property, and this is particularly for those assets that you would want to dispose of. Airports and stadiums and the classification of those, classification of cemeteries, and this is particularly an issue between, let's say, property, plant and equipment and heritage assets. And then, quite importantly, accounting for changes to the use of land and buildings and whether or not it would be moved between investment property and property, plant and equipment. In terms of how we have addressed these issues, we do have an asset decision tree that quite clearly takes you through the rationale between how land and buildings and other assets should be classified between the different standards, and you can access that on our website. So not necessarily going to provide any additional guidance on the classification or distinction, at least, between land and buildings and whether or not it should be inventory or investment property. The decision tree is quite comprehensive. In terms of the classification of stadiums, we do have a frequently asked questions. So these are the frequently asked questions we issue as staff on our website that will assist you with that. And obviously for amendments for airports, if it's within your mandate, you would be classifying that as property, plant and equipment. Otherwise, it would be investment property. We do have an existing FAQ on heritage assets, and it does deal with sort of statues and sculptures and monuments and all of these kinds of things, and whether or not they would be property, plant and equipment and investment property. And really the key thing to have a look at is what is the significance of those kinds of assets, either from a cultural, historical, scientific, etc. Rationale, and the same would really apply to cemeteries. So I think a very good example is we know of some cemeteries that would be heritage assets because there are historical figures that are buried in those cemeteries, whereas others it's really just a pretty functional exercise. So in those cases, those would potentially be property, plant and equipment. But we have amended the FAQ to explain the situation with cemeteries. The transfers to and from investment property, this is actually an area where the ASB has also issued additional guidance to its standards. So it's something that we have picked up during our proposed improvements to the standards of GRAP, which were issued last year for comment, and we'll finalise those hopefully now in March 2020. So the guidance already exists internationally, and we'll just include that in our standards. I'm going to move on to the second finding, which was assessing useful lives and residual values. And what we had heard quite a bit during our consultation with preparers in particular on GRAP 17, the previous requirement was that you needed to assess the residual values and useful lives of assets on an annual basis. And what we had heard is that assessment was quite onerous, and in many instances it had seemed as if there was a requirement to do a condition assessment on all of your assets each year. Now, generally the condition assessments are driven by an entity's asset management policies and practices. It's usually an engineering discipline. So condition assessments would be done based on a risk profile of certain assets. So some would be assessed every year, but others wouldn't. And it seemed that by including this requirement in GRAP 17 to review the residual values and useful lives on an annual basis, by implication it meant a condition assessment each year. So that was not the case. So to alleviate some of the practical issues with implementation of this requirement, what we have said is that you will go ahead and review the residual values and useful lives if there's an indication that has been triggered, and we introduced a number of indicators that you can have a look at to decide whether or not you should go and do further testing. So it's fairly similar to the impairment testing, where only if there's an indication do you go and do more work. You don't need to do this annual review when you know there's no specific change that has happened. So to give you a flavour of the types of indicators that we introduced, you would really have a look at the composition of the asset and whether or not that has changed. So let's say the components, for example, if you had to replace certain pipes or cables or whatever it is with newer kind of technology or still older technology, maybe that would affect the useful lives. You would have a look at whether or not the use of the asset has changed. So a fairly good example, take a vehicle. If you're using it in the city to deliver goods and services around the city versus using it on a construction site, obviously you would appreciate that the useful life could vary for those situations. Importantly, if you can see that the asset is approaching the end of its useful life, you would obviously need to go ahead and have a look at whether or not the useful life should be extended if you plan to use the asset past its originally assessed useful life. If there's been any particular delays in repairs and maintenance, you would need to go and have a look and see what the effect of that is and whether it's going to shorten your initial anticipated useful life. Quite importantly, environmental factors play quite an important role in assets, particularly roads. Obviously water and heat has quite a significant effect on them. So really having a look if there's been significant amount of rain or if there's been drought and how that is really affecting the useful lives of assets. So if you sort of trigger one of these indications, you would then go and do more testing. What we had heard from preparers is really that the feedback is that the indicator-based approach has alleviated the burden. Some of the financial statements that we reviewed did explicitly indicate that they had had a look at these indicators, while others still indicated that they had done an annual review. So obviously in those instances it's quite hard for us to know if the indicator-based approach was applied and maybe it was just the accounting policy that wasn't updated. But I think overall preparers are happy with the change. The one concern from our perspective, I guess, is that we still saw a significant volume of fully depreciated assets still in use. And obviously we are mentioning material assets here, it's not immaterial items. and sort of unpacking with preparers why it is that we were seeing this in the financial statements. I think what we had heard is that there's significant uncertainty about the accounting treatment of fully depreciated assets still in use. So for example, if I didn't go ahead and do these reviews in previous years, what would the consequence be versus if I did actually do the review but maybe the period that I used was inappropriate or circumstances have changed. And I think it could be an error or it could be a change in estimate. So if you really just didn't do the review or the assessment last year, it will obviously be an error. But if, for example, you made an assessment saying the asset is fully depreciated, I had plans to replace it in the next year, perhaps I didn't get the full budget allocation that I needed, I'm actually just going to sweat the assets and use them for longer. In those situations, it could be a change in estimate. So some of the other reasons that we had heard about having significant fully depreciated assets still in use was the delayed timing of the useful life and residual values reviews, and this is really entities just not doing the reviews as and when they should be. And as I mentioned, one of the indicators that we had inherently built in was really if the asset is approaching the end of its useful life, you should be reviewing it. So I think it's just something for entities to have a look at. The last thing that we had heard is that there may be some complexity with the IT systems and the useful life that you initially input into your system. Have heard that some entities with their systems are not able to change the useful life. So any subsequent changes are really a manual process, which obviously does cause some complexity and is obviously some added work. So in terms of the way forward, what did we decide to do with what we had seen? I think our main concern in terms of the indicators was really the existence of fully depreciated assets that we still see in the financial statements. And I think it's really a lack of understanding about what to do if there are fully depreciated assets. As I mentioned, is it an error or a change in accounting estimate? And our FAQ that we have issued really covers this in a significant amount of detail. So I think what we have been trying to do is really raise a lot of awareness about the existence of the FAQ and obviously education around how to treat these changes. I think the other thing that we just want to emphasize is that obviously these kinds of changes only relate to material assets and obviously have a material effect on the financial statements. So I think the other thing that we have been trying to do in terms of fully depreciated assets and reviewing the useful lives and residual values, I think many entities still see it as a sort of technical accounting exercise, but it is actually a good asset management principle and a good financial management discipline. So I think to understand why it is that you are doing this, it's not just an accounting exercise, it really is to reflect how the asset is being consumed and allocating it appropriately over the right periods. We have had a review of the existing FAQ to see whether or not it addresses all of the issues that were raised, particularly around the delayed reviews for budgetary or other kind of purposes, and have made some amendments. And again, just trying to raise awareness about the FAQ and its existence and the changes that we have made. Quite importantly, I think if you subscribe to our newsletter, you would have seen during the course of last year, we also had a couple of features on fully depreciated assets and how to deal with them. We're going to move on to finding number 3, which is the use of valuers. And just some context, the initial requirements in the standards sort of said that if you apply a revaluation model or you determine fair value, that you you can use a valuer, but it's not a requirement to do so. And there was some disclosure about if you do use an external person, providing some information about that in the financial statements. I think what we had heard quite a lot is that some entities, particularly municipalities, do actually have internal experts, property experts. You would appreciate that many municipalities are involved in preparing the valuation role, and they do have the ability to provide valuations of particularly land and buildings. So the question was whether or not they always had to use an external person, whether it was a requirement of the standard or whether or not they could use internal expertise. So we had amended the standards to make it clear that you can use internal people as long as they are equipped to do the valuations in terms of the requirements of the standard. So if we're using a fair value model or a revaluation model, the entity doing the calculation should actually be doing it in terms of the requirements of the standards. So what did we find? We obviously didn't find explicitly that entities were using internal people, for the most part because it's not a requirement for you to disclose in the financial statements anymore whether you used internal or external people. I think what we had heard quite a bit though is that there's a bit of concern about whether or not the auditors would accept valuations from an internal person, and obviously from an audit point of view the auditor would need to apply his or her mind to what the qualifications, expertise, process, etc. is that the valuator is using, whether or not they are internal or external. And I think the call was to really provide some guidance on assessing whether or not the expert is competent to actually do these valuations in terms of the standards. So from a way forward point of view, I think we have had discussions with the AGSA about the use of valuers. Again, it's not even a requirement from an audit perspective to necessarily have an external person. It's really about the competency and process that that person will apply. Obviously, assessing the competence of people to undertake these valuations is not within the board's mandate, so we have obviously provided this kind of information to the National Treasury for potential assistance. I think for the most part though, what might be useful is some educational material on really how to go about documenting the expertise of the person as well as the process that was followed, because probably that's where some of the deficiencies could lie. Moving on to finding number 4, having a look at the encouraged disclosures that we had deleted in the financial statements. I think when we had reviewed GRAP 16 and 17 and had an engagement with preparers, I think what we had found quite a lot is that there were some encouraged disclosures, and it was really uncertain whether or not entities should apply their own discretion in applying this information, what should their thought process be, and then quite importantly, I think quite a bit of pushback from the auditors saying, well, if it's in the standard then you have to apply it even though it is just encouraged. And I mean, 2 of the most significant ones was really about fully depreciated assets still in use, and then the fair value of certain assets in certain instances. So I think the board took a view to say that we should be quite diligent in either prescribing disclosures or having nothing. Having encouraged disclosures obviously requires entities to apply judgment to understand whether or not this information would be useful or not. And if the board is sort of on the margins, then potentially take it out of the standard. So we went through a process of removing the encouraged disclosures where we felt these were not going to be useful to users of the financial statements. And in terms of what we had found, again, linking back to fully depreciated assets still in use, this was something that was required. It was an encouraged disclosure. And obviously this is not really in line with our principle that entities should be reviewing useful lives and residual values of assets, so that's why we had proposed to take it out. We still see this kind of information being presented in the financial statements, as I had mentioned, and sort of in prompting preparers to give us information about why it is that this is still being presented. I think many of them had indicated that some of them do have significant holdings of fully depreciated assets, and what they are doing is really going through a process of reviewing whether or not they should be making changes or not, and that's why they still, some of them at least, still have this disclosure in their financial statements. We did receive some requests to say, well, potentially we should reinstate the disclosure but make it required that entities should disclose fully depreciated assets that are still being used, but obviously this is in contravention with the principle that you need to make these adjustments, particularly if they are material. So that's really the findings that we had on the encouraged disclosures, and I guess the area of concern again is still fully depreciated assets, which I dealt with earlier. Finding number 5 deals with disclosure of capital work in progress, and this was really an ask from the users of the financial statements that we consulted with during the post-implementation review on GRAP 16 and GRAP 17. I think what we had heard is that for the most part, preparers present capital work in progress in the financial statements as a class of assets on its own. The rand value of capital work in progress just seemingly increases every year, as opposed to actually seeing a reduction from time to time as projects are completed. It wasn't particularly clear either what is being constructed, because it is really just this global number that's being presented in the financial statement. So really a clear lack of transparency about what goes into work in progress, what the nature of that is, and seemingly nothing being reduced over time. So users had requested us to provide disclosure on assets that are being constructed or developed, and then obviously delays experienced in completing the capital projects. So our amendment really focused on requiring entities to disclose the carrying value of the cumulative expenditure that's been incurred on capital work in progress, and obviously showing that by class of assets. So this would give you an indication of whether it's a building, whether it's infrastructure, and probably the various components, but obviously getting a feel for what it is that's being constructed and then what the value is associated with each of those classes. The other ask was really to ask prepare us to disclose whether or not work in progress is taking significantly longer to complete than expected. So obviously entities would be applying judgment to decide, well, if I have a 5-year project and I should be sort of halfway completed and I'm sort of in year 4 and have done nothing, obviously that would require some sort of disclosure in the financial statements. We get a lot of questions about what significant means, but it's significant in relation to what your plan was. So you would obviously need to build some criteria in yourself. The other aspect is we do hear quite a bit that capital projects get halted. For various reasons. It could be for legal reasons, but the one that we see quite a bit is no budget. And I think then users are starting to ask, well, why is it sitting in capital work in progress if there's no progression on that project? And I think the immediate response is obviously needing to provide some information about if you have halted the project, whether or not you provide it for impairment or not. And then I think the next logical step would just be whether or not you de-recognize that, but that would come through in other disclosures. So what did we find in terms of the application of this requirement? It's really that we still see that entities still present capital work in progress as one column, one line item, or whatever the case might be, which is really not in the spirit of the amendment, going back to users saying that there's just no transparency about this number. So some may have provided some analysis of this particular number in the notes to the financial statements, but I think the requirement is to disclose per class of assets. So I think entities would need to do that. We had also received the requests to standardize the disclosures, particularly on capital work in progress that's taking a significantly longer period of time to complete than anticipated. I think some entities have this idea that this is an aging of capital work in progress, sort of the projects. That's not the requirement. You don't need to do it for each project. You really just need to identify when there's been a significant delay and then obviously provide information in the financial statements on that. So obviously, again, because capital projects vary from entity to entity, it's quite difficult to standardize these disclosures, but that was the ask. The next one was really to provide disaggregated information about this, and this is kind of the aging of the capital work in progress and the various projects. Again, you would need to apply your mind to the type of project that you have and really what's significant, rather than having standardized disclosure across all entities. And we had also been asked, we had issued an FAQ explaining what significantly longer means, and we had sort of used it as a percentage in the FAQ that we had issued. And I think what some entities have done is understood that to be the only way to measure what significantly longer means, and obviously that was not the intention. So the way forward on these amendments is that we will really have a look at revising the FAQ to explain what significantly longer means. As I mentioned, using this percentage-based approach is not the only one. And then really to have a look at, although entities made a request to standardize the disclosure, I've already explained it's quite difficult for the board to do that given the different types of entities that apply GRAP, as well as the nature of the various projects that they undertake to standardize these disclosures at the moment. As mentioned, entities are still not providing, or at least some entities are not providing this kind of disclosure in their financial statements fully as yet. So probably we need to see some practice emerging if we want to do some sort of standardization to understand, is there some commonality about what is being presented by entities before we can do this. So we will monitor developments in this space and then really have a look and see if we can do anything, but the board doesn't plan to do anything at the moment. The last finding is finding 6 on the disclosure of repairs and maintenance, and this is quite a controversial change for a number of reasons. And just to give you an indication, it was obviously not a requirement previously of any of the asset standards or GRAP 1 on presentation of financial statements to separately disclose repairs and maintenance. If you think about GRAP 1, generally we present expenses by nature or by function. So obviously you don't buy repairs and maintenance, you would buy all the services or goods that go into fulfilling that activity. So you would generally not see a line item in your financial statements that says purchase of repairs and maintenance, unless of course you sort of have a particular works department that deals with repairs and maintenance. Potentially that could be a function. But really what users want to do for the most part is really assess the adequacy of repairs and maintenance, the expenditure in relation to the carrying value of the assets. And obviously they were not getting that type of information from the financial statements. So users in particular had asked for this information, and what they wanted to see was repairs and maintenance being disclosed somewhere in the financial statements. It obviously doesn't fit within the GRAP 1 disclosure, so we had to have a look at the individual asset standards. So what we had amended the standards to indicate was that you needed to disclose the repairs and maintenance for the various types of assets. So for example, repairs and maintenance on investment property, repairs and maintenance on PP&E or on heritage assets. And it would really have been a disclosure in the financial statements. Quite importantly though, is that the standard does not describe or explain how you should calculate repairs and maintenance. This is obviously something that the entity would need to determine itself in terms of its own accounting policies and practices. So what we had seen is that the disclosures varied to not having provided this information in the financial statements at all, or not being applied as required. So for example, there might have been one repairs and maintenance number in the income statement, which obviously is incorrect in terms of the GRAP 1 classification potentially, or perhaps entities didn't split the repairs and maintenance between the different kinds of assets, so investment property, PP&E or heritage assets. Many preparers indicated that they didn't really see the need for providing this information, and obviously provided a lot of insight to the practical difficulties that could exist. And I think a lot of that could be as a result of, if I have repairs and maintenance, to split it, for example, between investment property, PP&E and heritage assets. We had also heard quite a bit about the uncertainty about the classification of expenditure between nature and function, and this goes back to my earlier remarks about you wouldn't necessarily see repairs and maintenance being a line item in the statement of financial performance just because it wouldn't automatically meet the classification by nature, maybe by function. We had also heard quite a bit of misunderstanding about the alignment between the GRAP requirements and that of the Municipal Standard Chart of Accounts project, particularly around contracted services. So in terms of what it is that we are going to do, or have done at least, we do have a frequently asked question explaining how repairs and maintenance should be presented, and particularly explaining the nature versus function idea. We did have a look at this FAQ after the results of the review came out, and we have made some amendments. So I think for the most part we are not going to make any changes to the standards, but we are really going to focus on the amendments that we have made to the FAQ and understanding if they are sufficient.